Why don't mortgage rates drop even when the Fed cuts rates? In this video, I'm going to explain what factors impact mortgage rates and why the Federal Reserve's rate cuts don't necessarily directly impact mortgage rates. I'm also going to share my mortgage rate predictions for 2025 and what you can focus on if you're planning to buy or refinance this year. I'm Darren Tsai. I'm a licensed real estate agent and loan officer in California. My channel's dedicated to educating people just like you so you can build wealth through real estate. Before I dive into all the details of this video, I just want to say when looking at mortgage rates in real estate, don't just look at the short-term impacts of things. I want you to always consider your long-term financial goal. All right, now that I got that off my chest, let's dive into the main factors that impact mortgage rates. There's going to be three main factors. Some of those things are in your control, and some of those things are going to be out of your control. The three main things are going to be economic factors, lender-specific factors, and borrower-specific factors. The first economic factor is a word that we've been talking about a lot lately: inflation. And if you don't know what inflation is, that's okay. Inflation is just the rate at which the general level of prices for goods and services rise over a period of time. And inflation leads to decreased purchasing power. That means that your $1 today is worth less tomorrow. The second major economic factor that plays a part in mortgage rates is Treasury yields. Treasury yield is the interest rate the US government pays investors for lending money. And that's through purchasing Treasury bonds, notes, or bills, commonly known as T-bills. And historically, mortgage interest rates have tracked with the 10-year Treasury bond yield. So historically, when the yields of the 10-year go up, mortgage rates also increase, and vice versa is true. If the 10-year Treasury bond yield goes down, mortgage rates typically follow. The next factor is economic growth. So if we are in a strong economy and unemployment is low, this typically increases the demand for housing and mortgages. More people are going to qualify. You're in a stronger economy. More people will want to buy a home. This typically leads to higher interest rates because they have more demand for it. And the opposite is true if we're in a weak economy. They'll probably lower those mortgage interest rates to help jumpstart the economy. And speaking of economy, the next factor is the Federal Reserve and monetary policy. So if you're not familiar with what the Federal Reserve does, is they control the federal funds rate. The federal funds rate basically determines the cost that banks can borrow money at. So the Federal Reserve controls that federal funds rate. Once again, that's the cost to banks for borrowing money. But this rate doesn't always have a direct impact on mortgage rates. And so you might be wondering, okay, what does have a direct impact on mortgage rates? And this is the last economic factor. This is the market and the demand for mortgage-backed securities. If you don't know what a mortgage-backed security, that's totally okay. It's basically when lenders bundle mortgage loans into a security as an asset, and then they sell that asset to investors. And so if you've never seen the movie The Big Short, they do a great job explaining what mortgage-backed securities are, and then they also show how they caused the 2008 financial crisis.
You're saying that at 8% the bonds fail, and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
What you need to know about mortgage-backed securities in terms of how they affect interest rates is that if the demand for mortgage-backed securities is high, lenders can offer lower interest rates. If the demand for mortgage-backed securities is low, then interest rates are going to be higher. Now that I've covered the economic factors that are out of your control that impact mortgage rates, I'm going to talk about lender-specific factors. You can't really control these, but you can control what lender you decide to work with. So just keep in mind, lenders are going to have different business strategies and different risk profiles, and they may change what mortgage interest rates they're offering based on current competition. What do I mean by business strategy and risk profile? Some lenders are going to look for higher risk clients, meaning they have lower credit scores. Maybe they don't have a W-2 job, but they are self-employed. They're going for a different borrower profile. They may go for these higher risk borrowers because they can charge a higher interest rate, thus making more profit. On the other side of that, there's lenders that are looking for higher income, W-2, high credit, low risk profiles, giving crazy low interest rates for those borrowers. So keep in mind, when I say risk profile, That I'm just talking about the credit history and the borrower's financial profile. Depending on the borrower's financial profile, one lender might offer lower fees compared to another for the same exact interest rate. And that is simply because their company has certain guidelines they want to follow. The third factor when it comes to mortgage rates is borrower specific factors. And these are the things that you can control. Going back to the borrower's financial profile I just talked about, this is where lenders are going to be looking at you, the borrower, and your credit score, your loan to value, and your debt to income ratio. And so your credit score, obviously, you do have control over that, right? Normally, if you have a higher credit score, you're getting a better interest rate or lower fees. Loan to value is just the amount of loan compared to the value of the home. Really simple example, if you have a home that's worth $1 million and you have a $500,000 loan, your loan to value is 50%. Typically, if you have a lower loan to value, you're going to get a better interest rate and pay less fees for that rate compared to a higher loan to value, because lower loan to value means less risk. And then debt to income ratio. That just takes into account your monthly liabilities that you have to pay compared to the monthly income that you have. So the lower debt to income ratio you have means you are less risk, you're going to have a better interest rate and pay less in fees for that rate, typically. If you want more details on these specific borrower factors, I made a video covering mortgage basics, and I'm going to link it in the description below. Now that we've gone over the factors that impact mortgage, the thing that you've been waiting for, why don't Fed rate cuts directly impact mortgage rates? That's because mortgage rates are tied to long-term bonds, not just the Fed's short-term rate. And as we mentioned before, the federal funds rate impacts the cost of borrowing for banks. It doesn't impact mortgage rates directly. The changes in the cost of borrowing for the banks might be pushed into mortgage rates. So as I mentioned before in the video, the market on mortgage-backed securities has a huge part in mortgage rates. And so if there's a lot of market uncertainty, they might demand higher returns on those mortgage-backed securities, which means consumers are paying for higher mortgage rates. Now that you have a good understanding of these different factors that impact mortgage rates, I'm going to share my 2025 mortgage rate predictions. These are just my opinions. I've definitely been wrong before, and if we have some major black swan event, that could obviously change my predictions too. Based on the economic factors and reports available right now, I don't see mortgage rates changing too much because there's uncertainty in the market and inflation is still pretty high. The Federal Reserve recently said that they are not going to cut rates. They're pausing that right now because inflation is still high. Now, obviously, if we see a major recession or we see these unemployment reports changing, then rates could go down. If you want to stay up to date with current mortgage rates and news affecting mortgage rates, you can go ahead and sign up for that email. There's a link in my description for it. If you've decided to sign up for it, that's great because you're doing what you can control. You're staying educated on what's going on with the market. If you're thinking about buying or refinancing this year, I want you to focus on those borrower-specific factors that we talked about. Credit, debt to income, and loan to value you may or may not be able to control. So let's focus on improving your credit, lowering your debt, and making sure that when you do buy or refinance, talk to multiple lenders. I say this to all my clients when it comes to real estate. Make sure the numbers make sense for you and your family's long-term goals. At the end of the day, you can't control the economic factors in the market, but you can control how prepared you are. Nobody knows exactly what interest rates are going to be in 2025, but what we do know is that your success depends more on your preparation than anyone's prediction. If you found this video helpful, I'd really appreciate it, and I'm sure they would too, if you could share this video with someone that needs to watch it. And if you'd like to chat about your specific scenario, you can email me here. As always, thanks for watching, and I'll see you on the next one.